We've got an analyst now joining us. Prabal Sen is energy analyst at ICICI Securities. Prabal, thanks very much for your time. So just come in on Reliance and where it stands in terms of prospects, what's in the price, refining margins, etc. going to be super strong. Your thoughts?
Yeah, absolutely. I think with Reliance, the earnings growth trajectory has not really been in doubt even before the kind of momentum we are seeing in the refining segment. This is sort of the icing on the cake in many ways that, if Reliance actually starts delivering in excess of 18 to $20 GRMs in the near term, which is very much doable given what Singapore benchmarks have done, I think OTC earnings would probably once again start to have a much more dominant position in the earnings mix, at least over FY23, given the trends that we see. And I think Reliance is one of the few large cap companies which has the potential for high teens or even mid 20% kind of an earnings growth over the next couple of years. So from an earnings growth perspective, I think there's very little doubt Reliance will stand out, and obviously that is driving momentum in the stock. We have an ad rating, however, on the stock because our sense is that if you look at the way that the stock has behaved and what is being factored into the stock, we do believe that the return ratios actually don't reflect the kind of earnings strength going forward because the capex cycle continues to run ahead of our expectations. That's the only slight quibble we have in the story as far as we are concerned. Okay. We believe that the capex momentum continues to be much higher, than what was estimated earlier. So that's the sole concern. Okay. But from an earnings perspective, clear outperform.
Clear outperform on Reliance Industries. Morning, Prabal. Thanks so much for joining in. What about the OMCs though? They're in a bit of a spot of bother. Some of them are going to 52-week lows. You have crude prices moving up. The rupee is depreciating as well. What kind of under recoveries are you penciling in, and how do you approach the stocks from here on? Go ahead.
Well, penciling in any kind of under recovery right now obviously is a bit tricky. I can tell you that in the first quarter, blended retail fuel losses are approaching about 12 to 13 rupees on an average, which is obviously a concern. We continue to obviously believe that there will be some normalization that will happen in the second half, once things actually cool down or there is some sort of stability that comes to crude prices. I think the OMCs might start to rejig their retail fuel prices, and hopefully, they come to at least a break-even kind of a situation. In the meantime, what is obviously keep helping them sort of keep their head above water is the very strong refining margins. Even for them, calculated margins seem to be in the $18 to $20 range if these trends continue. However, those will not be enough to offset more than maybe a 2 to 3 rupee kind of a net loss if I look on an annualized basis, or maybe as much as 5 to 6 rupees in the worst case. A 12 to 13 rupee loss is something that will be difficult to, sort of overcome, even with, even if we have to believe that we are getting a significant amount of Russian crude right now at, $20, $25 discount, as a lot of reports would indicate. So even if you factor that in, you have a case maybe for $22, $24 kind of GRMs, but that's not nearly enough to offset the damage from the marketing. So as and when price increases resume in petrol and diesel, I think that will remain a trigger and a key monitorable over the next few months. Other than that, I think people will probably be wary of sort of entering the stocks, despite the fact that we do believe that valuations are fairly attractive at these levels and are close to historical lows, as you mentioned earlier.
Okay, just a quick word on ONGC and Oil India. Both are in a sweet spot on the back of higher gas and oil prices. Good for more?
ONGC, unfortunately, I don't have under coverage, so refrain from commenting on earnings specifically. Obviously, it's a beneficiary of the kind of momentum that one is seeing in oil and gas prices. There's no doubt. I think earnings probably will continue to show very decent momentum. If you look at the average crude realizations for both the upstream companies last year, it was in the range of, I think, $76 to $78. What we are looking at right now, in this year, in the worst case, probably is $100 of net realizations, barring any regulatory or policy intervention for both the companies. So obviously, that's a significant uptick. And plus, as we've already seen, gas prices, even for nominated fields or formula fields, as we can call them, are at 6.8 net for April, and the estimates suggest that they will get to probably about $10 for the second half of the year. So, obviously from a pricing perspective, there's a lot
Got
of
it.
momentum. Oil India benefits from the NRL refining margins as well, and they have slightly better production growth. So we would say that Oil India probably stands in a better place.
And the market's been reflecting that. Prabal, thanks very much for your time. Good speaking with you. Well, Sudhir.